Most people think they know what caused the 2008 financial crisis. They picture greedy bankers on Wall Street, reckless mortgage lending, a housing bubble that inflated until it popped, and a government that had to step in and clean up the mess. It's a clean narrative. The villains are obvious. The lesson is simple. Don't lend money to people who can't pay it back. And for most people, that's where the understanding stops. But here's the problem. That story doesn't just oversimplify the crisis. It actively obscures what actually happened, who made it possible, and why none of them were ever held accountable. Because the 2008 financial crisis was not a case of a few bad actors making reckless decisions in an otherwise sound system. The system itself was redesigned, deliberately and methodically over the course of 2 decades, to make this exact type of catastrophe not only possible, but inevitable. And when you trace the decisions that built the machine, you don't find rogue traders or fly-by-night mortgage brokers. You find the most powerful people in American finance and government, working in concert to dismantle the safeguards that had kept the system stable for over 60 years. The real origin of the 2008 crisis involves a woman who saw it coming a decade early and was systematically destroyed by the 3 most powerful economic officials in Washington. It involves a regulatory change so obscure that almost no one reported on it, which allowed 5 investment banks to gamble with $40 for every $1 they actually had. It involves credit rating agencies that were paid by the very institutions whose products they were supposed to evaluate, a conflict of interest so blatant it would be illegal in virtually any other industry. It involves an insurance company that sold $500 billion in protection against losses it had no ability to cover. And it involves a rescue operation that spent $700 billion taxpayer dollars saving the institutions that caused the disaster, while 10 million American families lost their homes, and not a single senior executive went to prison. This is not the story of a market that malfunctioned. This is the story of a market that functioned exactly as it had been redesigned to function, and the people who redesigned it knew exactly what they were doing. So let's go back, not to 2007, not to the subprime mortgage boom, but to 1933, to the aftermath of the last time the American financial system collapsed. Because the 2008 crisis cannot be understood without understanding what was built to prevent it, and then understanding piece by piece how that architecture was torn down. In the wake of the Great Depression, the United States Congress passed the Banking Act of 1933, commonly known as Glass-Steagall. The law did something simple and profound. It drew a wall between commercial banking and investment banking. Commercial banks, the institutions where ordinary people deposited their savings, were forbidden from engaging in speculative securities activities. Investment banks, which underwrote stocks and bonds and traded on financial markets, were forbidden from taking deposits. The logic was straightforward, and it was born from bitter experience. During the 1920s, banks had used depositors' money to speculate in the stock market. When the market collapsed, the banks collapsed with it, and ordinary Americans lost everything. Glass-Steagall ensured that the money people entrusted to banks for safekeeping could never again be used as chips in a casino. And for 66 years it worked. The period from 1933 to 1999 was the longest stretch of banking stability in American history. There were recessions, market corrections, and isolated bank failures, but there was no systemic collapse, no repeat of the cascading bank runs that had destroyed the economy in the early 1930s. The wall held. And then, beginning in the 1980s and accelerating through the 1990s, that wall was dismantled, not by accident, not by market forces, but by deliberate legislative and regulatory action, driven by an ideology that held that financial markets were self-regulating and that government oversight was not just unnecessary but harmful. The most important moment came in 1999, when Congress passed the Gramm-Leach-Bliley Act, which formally repealed Glass-Steagall. The repeal was championed by Senator Phil Gramm, supported by the Clinton administration, and signed into law by President Clinton. But the truth is that Glass-Steagall had already been effectively gutted by regulatory exemptions granted throughout the 1990s. Citigroup had merged with Travelers Group in 1998, creating a financial conglomerate that combined commercial banking, investment banking, and insurance under one roof, a combination that was technically illegal under Glass-Steagall at the time the merger was announced. The repeal, in a sense, was retroactive legalization of a merger that had already occurred. The wall was gone, and the institutions that had been kept separate for 6 decades were now free to combine depositors' savings with speculative trading in a way that hadn't been possible since the 1920s. Now here is where the story takes the turn that most popular accounts, either miss entirely or compress into a footnote, and it is arguably the single most important decision in the entire chain of events that led to 2008. In 1996, a lawyer and financial regulator named Brooksley Born was appointed chair of the Commodity Futures Trading Commission, the CFTC, the federal agency responsible for overseeing derivatives markets. Derivatives, at the time, were a relatively obscure corner of finance, contracts whose value was derived from some underlying asset, a stock, a bond, an interest rate, a commodity. But the derivatives market was growing at an extraordinary pace, and much of it was trading over the counter, meaning directly between institutions, outside of any exchange, with no transparency, no standardized contracts, and no regulatory oversight. Born recognized the danger. She had spent her career in financial law, and she understood that a vast, opaque, unregulated market in which the largest financial institutions in the world were making enormous bets against each other, with no one tracking the size of those bets or the ability of the parties to pay if the bets went wrong, was a systemic risk of the highest order. In 1998, she proposed that the CFTC begin studying whether the over-the-counter derivatives market needed regulation. She did not propose specific rules, she proposed a study. The response was immediate, coordinated, and devastating. Federal Reserve Chairman Alan Greenspan, Treasury Secretary Robert Rubin, and Deputy Treasury Secretary Larry Summers, the three most powerful economic officials in the United States, jointly opposed Born's proposal. Greenspan, whose belief in the self-regulating nature of financial markets was virtually religious, argued that regulation would drive derivatives trading offshore and reduce American competitiveness. Rubin and Summers supported Greenspan's position. The three of them testified before Congress, lobbied against Born's initiative, and used their institutional authority to ensure it was killed. Born was marginalized, publicly undermined, and effectively forced out of her position. She resigned in 1999, and in 2000, Congress passed the Commodity Futures Modernization Act, which explicitly exempted over-the-counter derivatives from regulation by the CFTC or any other federal agency. The bill was signed into law by President Clinton. The single person in the federal government who had identified the exact mechanism that would destroy the global economy 8 years later was silenced, and the instrument of destruction was given explicit legal protection. And here is the detail that should make you deeply uncomfortable. When the crisis hit in 2008, the unregulated derivatives market, the precise market Born had tried to bring under oversight, had grown to a notional value of over $600 trillion. That is not a typo. 600 trillion, roughly 10 times the entire gross domestic product of the planet. And now the machine was built. With Glass-Steagall gone and derivatives unregulated, the final pieces fell into place with remarkable speed. In the years following the dot-com crash of 2000, Federal Reserve Chairman Alan Greenspan cut interest rates to historic lows, bringing the federal funds rate down to 1% by 2003. The intention was to stimulate the economy after the recession. The effect was to flood the financial system with cheap money that needed somewhere to go, and it went into housing. Mortgage lending exploded, but not the kind of mortgage lending that had existed for decades. The traditional model of mortgage banking, in which a bank lent money to a homebuyer and held the loan on its own books, collecting interest payments over 30 years, had been replaced by something fundamentally different. Under the new model, a mortgage originator would make a loan, then immediately sell it to an investment bank. The investment bank would bundle thousands of these loans together into a financial product called a mortgage-backed security. That security would then be sliced into tranches of varying risk and sold to investors around the world. The originator who made the loan bore no risk if the borrower defaulted, because the loan had already been sold. The investment bank bore no risk, because the securities had been sold to investors, and the investors believed they bore no risk because the securities had been rated as safe by the credit rating agencies. Every participant in the chain was making money, and no one in the chain had any incentive to ask whether the borrower could actually repay the loan. The result was predictable. Lending standards collapsed. Mortgage brokers began issuing loans with no income verification, no asset verification, and no down payment. The industry developed its own vocabulary for these products. Ninja loans, no income, no job, no assets. Stated income loans, in which the borrower simply wrote down whatever income they chose and the lender accepted it without verification. Adjustable rate mortgages with teaser rates that started low and then reset to levels that borrowers could never afford. These were not loans designed to be repaid. They were loans designed to be sold. But the mortgages themselves were only the raw material. The real alchemy, the process that turned bad loans into a global catastrophe, happened on the desks of the investment banks that packaged them and in the offices of the credit rating agencies that blessed them. And this is where the conflict of interest becomes so grotesque that it is difficult to describe without sounding like a conspiracy theorist, except that every detail is documented, confirmed, and in many cases admitted under oath. The three major credit rating agencies, Moody's, Standard & Poor's, and Fitch, were responsible for evaluating the risk of mortgage-backed securities and assigning them a rating that investors around the world relied upon to make decisions. A AAA rating, the highest possible, indicated that the security was as safe as a United States Treasury bond. And the rating agencies assigned AAA ratings to thousands of mortgage-backed securities that were filled with loans made to borrowers who could not repay them. The reason was structural, and it was financial. The rating agencies were not paid by the investors who relied on their ratings. They were paid by the investment banks that created the securities being rated. If Moody's refused to give a favorable rating, the bank would simply take its business to Standard & Poor's. The agencies were competing for revenue from the very institutions they were supposed to evaluate. Internal emails later revealed by congressional investigations showed that rating agency analysts understood exactly what was happening. One analyst wrote that a deal could be structured by cows and they would still rate it. Another noted that the ratings would not hold and that the agencies would be blamed when the market collapsed. They rated the products anyway, and investors around the world, pension funds, insurance companies, sovereign wealth funds, municipal governments, bought trillions of dollars of securities that they believed were safe because the rating agencies told them so. And then there was AIG, the American International Group, one of the largest insurance companies in the world. Within AIG, a small division called AIG Financial Products, based not in New York but in London, began selling a financial instrument called a credit default swap. A credit default swap is, in essence, an insurance policy on a financial product. If you own a mortgage-backed security and you're worried it might lose value, you can buy a credit default swap from AIG, and AIG promises to pay you if the security defaults. In exchange, you pay AIG a regular premium. Under traditional insurance regulation, an insurance company is required to hold reserves sufficient to cover its potential liabilities. But credit default swaps were not classified as insurance. They were classified as derivatives. And thanks to the Commodity Futures Modernization Act of 2000, the law passed after Brooksley Born was silenced, derivatives were exempt from regulation. AIG Financial Products sold over $500 billion in credit default swaps without setting aside meaningful reserves to cover potential losses. They were collecting premiums on bets they could never pay if the bets went wrong. And simultaneously, in 2004, the Securities and Exchange Commission made a decision that received almost no public attention at the time but would prove catastrophic. The SEC relaxed the net capital rule for 5, and only 5, investment banks: Goldman Sachs, Morgan Stanley, Merrill Lynch, Lehman Brothers, and Bear Stearns. The rule change allowed these 5 firms to dramatically increase their leverage ratios, in some cases borrowing $30, $35, or even $40 for every $1 of actual capital they held. This meant that a loss of just 3% on their investments would be enough to render them insolvent. All 5 of these firms would either fail, be acquired in emergency sales, or be forced to convert into bank holding companies within 4 years of the rule change. The machine was complete. Unregulated derivatives, corrupted ratings, unrestrained leverage, mortgages designed to fail, and an insurance company that had promised to cover losses it could never afford to pay. Now let me bring all of these threads together, because the 2008 financial crisis was not a single event. It was a cascade, and every failure triggered the next. When housing prices stopped rising in 2006 and began to fall in 2007, the first cracks appeared. Borrowers who had taken out adjustable rate mortgages saw their payments reset to levels they could not afford. Defaults began to climb. The mortgage-backed securities that contained those loans began to lose value. The AAA ratings that had been applied to those securities were revealed as fraudulent, and the credit default swaps that AIG had sold, promising to cover those losses, were suddenly triggered, all at once, across hundreds of billions of dollars in exposure. Bear Stearns collapsed in March of 2008. 2 of its hedge funds, heavily invested in subprime mortgage securities, had failed the previous summer, and the firm's exposure to the deteriorating mortgage market made it unable to fund its operations. J.P. Morgan Chase acquired Bear Stearns at a price of $2 per share, a company that had been trading at over $170 per share a year earlier, with the Federal Reserve providing $29 billion in guarantees to facilitate the deal. In July, the government placed Fannie Mae and Freddie Mac, the two government-sponsored enterprises that guaranteed roughly half of all American mortgages, into conservatorship. Their combined liabilities exceeded $5 trillion. On September 15, 2008, Lehman Brothers filed for bankruptcy. It was the largest bankruptcy filing in American history, with over $600 billion in assets. The decision to let Lehman fail, after Bear Stearns had been rescued, sent a shockwave through the global financial system. Credit markets froze. Banks stopped lending to each other. The commercial paper market, which corporations relied on for short-term funding, seized up. Money market funds, which millions of Americans treated as safe alternatives to bank accounts, began losing value, an event known as breaking the buck, something that had happened only once before in history. The next day, September 16th, the Federal Reserve provided an $85 billion emergency loan to AIG, which was hours away from collapse due to its credit default swap obligations. That bailout would eventually grow to over $180 billion. And within weeks, the United States government passed the Emergency Economic Stabilization Act, which created the Troubled Asset Relief Program, TARP, authorizing $700 billion in taxpayer funds to purchase toxic assets from the financial institutions that had created them. The contagion spread globally. Banks in Iceland, Ireland, and the United Kingdom required government bailouts. European sovereign debt markets came under severe stress. Stock markets around the world collapsed. The crisis had gone from American housing to the global financial system in a matter of months. The human cost of this cascade was devastating and deeply unequal. The American economy lost 8.7 million jobs between 2007 and 2010. The unemployment rate doubled, reaching 10%. Roughly 10 million American families lost their homes to foreclosure. Household wealth declined by over $13 trillion. Retirement accounts were decimated. College funds vanished. Families that had spent decades building modest financial security watched it disappear in a matter of months, and the distribution of that pain was profoundly asymmetric. The financial institutions that had created the crisis received hundreds of billions of dollars in government support. Their executives retained their positions, their bonuses, and in most cases their personal fortunes. Not a single senior executive at any major Wall Street bank was criminally prosecuted for conduct related to the crisis. Not one. The Department of Justice, under both the Bush and Obama administrations, declined to bring criminal charges against the individuals who had designed, sold, and profited from the financial instruments that destroyed the global economy. The contrast is not subtle. A homeowner who lied on a mortgage application could be charged with bank fraud. The bank that designed the application to discourage accurate reporting, that created incentive structures rewarding volume over verification, that packaged those loans into securities and paid rating agencies to certify them as safe, faced no criminal liability. Fines were levied against institutions, billions of dollars in settlements that sounded enormous in press releases but represented a fraction of the profits those institutions had earned during the boom. The fines were paid by shareholders and absorbed as a cost of doing business. The individuals responsible kept their money, and the comparison to other nations makes the disparity even starker. Iceland, whose banking sector collapsed in an even more dramatic fashion relative to its economy, prosecuted and imprisoned over 24 banking executives. The United States, with the most sophisticated legal system in the world and the most extensive documentary evidence of institutional misconduct in financial history, prosecuted none. What historians get wrong about the 2008 financial crisis, time and again, is treating it as a failure of the market, an unfortunate consequence of excessive risk-taking that was corrected by regulatory reform. That framing is not just incomplete, it is misleading. The crisis was not a market failure. It was a regulatory failure, an institutional failure, and in many respects a deliberate policy choice. The safeguards that had prevented this type of collapse for 66 years were systematically removed. The one regulator who identified the danger was silenced. The rating system that investors depended on was corrupted by a structural conflict of interest. The leverage limits that constrained risk were relaxed for the institutions that posed the greatest systemic threat, and when the system collapsed, the cost was transferred from the institutions that caused it to the taxpayers and homeowners who had no role in creating it. The Dodd-Frank Act, passed in 2010 as the legislative response to the crisis, introduced new regulations on derivatives trading, created the Consumer Financial Protection Bureau, and imposed some restrictions on proprietary trading by banks through what became known as the Volcker Rule. But many of those provisions have since been weakened, delayed, or repealed. The largest American banks are bigger today than they were in 2008. The derivatives market remains vast. The fundamental dynamic that produced the crisis, the ability of financial institutions to generate enormous private profits from activities whose risks are ultimately borne by the public, has not been eliminated. It has been at most modestly constrained, and the phrase that came to define the crisis, too big to fail, was never resolved. It was simply renamed too big to jail, and the lesson that the financial system absorbed was not that reckless behavior would be punished, but that it would be subsidized. This is why understanding the true origins of the 2008 crisis matters, not as an exercise in financial archaeology, but as a recognition that the architecture of the next crisis is already in place. The deregulatory ideology that produced 2008 did not die with the crisis. It survived, adapted, and in many cases reasserted itself. The people who warned about the dangers were proven right and remain largely ignored. The people who profited from the catastrophe were never held accountable and remain in positions of influence. The conventional story of 2008 tells us that a bubble popped, things got bad for a while, and then they got better. The real story tells us that the crisis was engineered not by conspiracy but by policy, by the systematic removal of every safeguard that stood between the financial system and catastrophe. And the most dangerous lesson of all is this: the same people who told us the market would regulate itself in 1999, the same people who silenced the woman who tried to prevent the crisis, the same people who argued that regulation was the enemy of innovation and growth, were never discredited. They were never replaced. And the system they built, the one that collapsed in 2008 and was rebuilt with public money, is still fundamentally the one we are living in today. They weren't evil, they were convinced that they were right. And the difference between a healthy financial system and a catastrophe that cost $13 trillion and 10 million homes came down to whether the people in charge valued stability or ideology, and whether the institutions around them rewarded caution or punished it. In 2008, caution was punished at every level, and the American public paid the price. If this story reshaped the way you think about how financial systems actually work and who they're actually designed to protect, take a moment and hit that subscribe button. We go deep on the forces that actually move markets, nations, and the global order, the kind of stories that don't make the evening news but quietly shape the world you live in. Drop a comment below. What do you think mattered most? The repeal of Glass-Steagall, the silencing of Brooksley Born, or the corrupted rating agencies? I'd love to hear your take. And if you haven't already, make sure to like this video. It genuinely helps the channel reach more people who care about understanding how power actually works. I'll see you in the next one.